Shall we go live? I think. Okay. Hi, good evening, everyone. This is Karthik here. Welcome to Ab India Karega Invest, our weekly initiative to reach out to all of you with a new topic and an interesting topic every week. Today, we are presenting a topic, what we call it as identifying the mid-cap opportunities in India. I think we have been in the last 2.5 years or so, we are going through a lot of exciting times. So to present on that today, we have Mr. Shane was. He's the senior product manager at Axis Mutual Fund. So when we talk about mid-caps, right, I think we have seen great stories of some of the mid-cap stocks or some of the mid-cap funds generating phenomenal returns in the last decade or so, or decade or two. We would have heard of stories where 10x, 20x, 100x, there is no limit. Basically identifying best of mid-caps would be like catching them young. Part of the wealth creation stories we all would have heard of. And I'm sure all of us would want to identify such stocks or identify such funds which helps us in terms of growing our wealth. So to present the topic, we have Shane here. I would like to welcome Shane on stage to present your views and also on how is it we can really execute this. One is identifying the opportunities itself, and at the same time, how do we really go about investing into it from a retail investor point of view. So stage is all yours, Shane. Thank you.
Thanks, Karthik. Pleasure to be on along with Groww. Groww has been a great partner for us on the digital side as we grow assets, and reach out to the millions in a way that we've not really seen in previous cycles. Today it's a great forum that we have. Today, if you were to look at where the Indian equity markets have evolved, you've got a great emergence of new ideas, new companies that come into the capital markets to raise high quality equity capital, and they're backed by very strong business fundamentals. There has been a gradual evolution of this over time, and as the Indian equity markets have become more and more fertile for quality business models, that has started coming to the fore. And increasingly so, if you were to look at where we stand, especially with the mid-cap space, the mid-cap space has become very dynamic. It is full of companies from across the spectrum. So you've got the old world business houses like the cement companies of the world. You've got the metal companies of the world. Mix that with new age companies. So, for example, you've got your new age IPOs that have recently come in. You've got your financial technology companies. You've got your e-commerce companies, and all of these that have made the mid-cap space a very bubbling ecosphere. As we look to navigate that, and today I will take you through some slides which I think would be of value to you and to your investors. I would like you to and urge you to keep an open mind of what we think will work. So with that, let's start. I want to share my screen. Karthik, can you just let me know if the screen is visible?
Yeah, Shane.
Superb. So let's start off. Let me just. This thing doesn't seem to be moving.
No, it is not.
I'm not able to move the screen. Sorry. Yeah. Thanks. Okay. So if you were to look at what are mid-caps today, so mid-caps, as per the SEBI definition, are the companies that are ranked number 101 to 250 companies. So SEBI has defined this category per se, and 150 companies is what the mid-cap universe is of today, right? And within this universe, what you will see is that within this universe, you will see companies that are fast growing, They are companies that are in the midst of finding their feet as to what they want to be portrayed as. So you've got companies that have got multiple business models. They've got companies with differentiated product strategies. They're a little bit of slightly volatile. So थोड़े हटके funds है, थोड़े illiquid funds है, and in is essence, what you've got is companies that are very very highly growth oriented, high with great potential in their business models, and in some essence they are very very niche companies. So they are market leaders in their own right. While they might not be category leaders per se, within a particular niche, you may see these guys are typical leaders or front runners in their businesses. The unique attribute of mid caps is that they give you the benefits of large cap companies, which is that they are a little more established, not fully established, but very very well established in their own space. And also they give you the benefits of small caps, which are higher growth, higher opportunity, and higher potential companies. What that effectively means is that you've got the very best of both. You've got the blend of small cap, and you've got the maturity of, say, the large cap companies. And what this is what most of us in the market sphere call as emerging companies. And emerging companies are companies with a high growth, like I mentioned to you, but they're also prone to certain cyclical risks. So most recently, you would have noticed when the markets were correcting, right, from September onwards to December, and even as we speak in March, markets are very volatile. You would see that mid caps are moving very very aggressively. So you've seen some companies that are very very rock solid stable companies that have actually gone against the grain, and some companies that have actually capitulated worse than the market. So that is the risk reward that mid caps offer you today, and that is what we're trying to play. Now, because this is very, very dynamic, there is a very important aspect of active management and identifying the best or good quality mid caps, because there is a big cost of mistakes. So when you make a mistake, like in most life decisions, if you make a big enough mistake, you would tend to regret it for the rest of your life, right? So there are, if you don't do your research, if you don't select the right product for you, the cost of mistakes can be very high, which is basically you will lose your capital. So the focus here is to identify or build a portfolio of mid caps, which is very very long term oriented, very sustainable, and which will give you your desired return. At the end of the day, what you want is a good investor experience, right? So that is what selecting the right mid caps is all about. Uh, Axis Mutual Fund has been doing this for a while. So we've been running mid cap portfolios ever since we started in 2009, and we've figured it out. We figured out certain attributes that makes mid caps very very lucrative. One of those aspects of mid cap investing is impact cost. Now, to our retail audience, to our retail investors, this is something that you may have heard for the first time. But think of it this way. Say, for example, I have got 100 shares that I want to buy of any company. Now, if in the market I go and see that there are 100 shares are very hard to find, that is a scarcity. So that there will be a scarcity premium, right? So I will go to somebody else who has those 100 shares, and then he will also think twice that, do I let go of these shares? If I let go, should I get a better price? So then there is a little bit of bargaining that you would do. That bargaining in the equity term or in equity markets term is called impact cost, which is a hidden cost. So most mid caps today are fairly liquid. But as you go down to the lower rounds of mid cap, so let's look at stocks like rank number 150, 150, 50, 100 and first onwards are your mid cap companies, right? So right up till 250. So the last 50 or 60 stocks may often be those that are not very frequently traded, or they might have an illiquidity premium or scarcity premium that you would call. Now, if you were to go and invest in that, first, your objective is to get a company which is well researched. So if it is a well researched company, that means a lot of people are buying and selling those shares because there is a lot of active aspect. And the best hallmark of a company, of a stock, or any investment for that matter, is your ability to liquidate. So in times when the markets are bad, or in times when there is a lot of selling pressure, your ability to liquidate that portfolio becomes a very, very important aspect. And especially, and this is why I'm talking to you about it in the mid cap context, because impact cost is something that is still plaguing our Indian equity markets, especially in the mid and small cap companies. How do we solve for that? We solve for that by identifying companies that are very, very actively traded. For example, companies that have very consistent trading volume. So when you look at the NSE screen or BSE screen, you see that on a regular basis you see a lot of trading. So let's say, for example, if you are a person who is doing 1 crore worth of trading, if you see that your stock, for example, on average has 10 or 15 or 20, 30 crore of trading per day, then you are rest assured that you will be able to enter and exit without a lot of impact cost, right? Also, for the fact that if that stock has derivative positions, yeah, it is trading on multiple exchanges like BSE or NSE, that adds to the value of that, or of that investment, because you can get in when you want, you can get out when you want, and that is the beauty of this, of understanding impact cost. What we have done, looking at all of these aspects of the quality of mid cap companies today, and the ability for us to manage portfolios of this nature. So what we did is we worked with NSE, and we realized that they have a product called the Nifty Midcap 50 Index Fund, which is actually a subset of the midcap universe. And what that brings to the table is that it gives you access to the 50 most liquid companies, and that has actually worked very, very well. So in a rules based passive strategy, what we can offer you today is a product wherein you can invest a very, very small quantum. You can start with 5,000 rupees, and you can get access to 50 of the most liquid mid cap companies. And all of this is a very, very rules based approach. So today, you when you buy with us, for example, you will know what are the 50 stocks that you're buying, because आप NSE के site पे जाओगे तो आपको दिखेगा वो पूरा, what are the constituents, what is the weights, all of that is available. And because we offer it in an index fund format, the index fund, all the benefits of a normal mutual fund. So आपको SIP करना है, SWP करना है, आपको STP करना है, या आपको 5,000 रुपीज या छोटे अमाउंट्स में आपको इन्वेस्ट करना है वेरी फ्रीक्वेंटली, बिकॉज आपका पोर्टफोलियो मे बी अ स्मॉलर पोर्टफोलियो, so you don't want to take that risk of putting all your money in midcap. So you can test the waters, and the forum also is very great, right? Today we are talking about India Karega Invest. So जाहिर सी बात है कि many of you are first time investors, or are looking to test the waters in a particular format, and a product like this is very, very unique and ideal for you to test the mid cap waters in a very controlled, very risk assured manner. And that is the beauty of this. The index itself is very dynamic. So it is a very broad index. So you've got almost 15 odd sectors that are there in that, and you've got a very granular portfolio. तो यहाँ पे top 10 stocks आपको दिखने को मिल रहा है. So the Tata Power, SRF, all of these companies are very hot trading favorites. All of these companies are very good, financially sound companies. तो आपको एक high quality portfolio मिल रहा है at low cost, at a very reasonably managed portfolio level basis. तो that makes for a very good investing perspective. And अगर आप देखेंगे more recently, because of the markets जो correct हुए हैं, जो data आपके सामने है, it is as of 20th of February. उसके बाद markets have also corrected. तो आपको दिखेगा कि जो markets में जो volatility या जो वो attributes हैं, all of that is controlled in this portfolio, and that is what makes this portfolio a very, very attractive portfolio for long-term investors. If you look at performance as well, the value add that selecting the most liquid stocks does is that it tends to outperform the markets as well. तो जब हम equity markets की बात करते हैं तो हमारा automatic perception है कि निफ्टी को बीट करता है कि नहीं. तो आप देखोगे ये index has been around for about 6-8 years, and आप परफॉर्मेंस देखोगे जब भी ग्रोथ फिनोमिनन आता है, टिपिकली यू वुड सी दैट मिड कैप्स हैव आउट परफॉर्म द ब्रॉडर मार्केट, एंड ये आपको दिखने को मिल रहा है, एंड that is why this product is an interesting aspect. तो आज अगर आप देखेंगे, इंडिया इज इन अ सेक्युलर ग्रोथ फेज, तो पैंडेमिक की जो पेन पॉइंट्स थे, दे आर नाउ बिहाइंड अस. Now you've got a very stable government. Elections जो हुए थे most recently are very pro government. Incumbent governments have gotten voted into power again. So all of this basically points to that India has all the right tailwinds for a very growth driven environment. And जैसे मैंने पहले भी बोला था, mid caps are more growth oriented in nature. So by virtue of looking at mid caps today, India is in a growth market. Mid caps are the most growth companies, so mid caps make a lot of sense when you invest. And जब आप देखोगे longer term consistency के basis पे, mid caps have delivered that consistent alpha. And जब आप म्यूचुअल फंड्स की बात करते हैं, आप you look for high quality alpha generation strategies. So mid caps as a strategy has been a typically value accretive strategy. करेक्शन के कारण वैल्यूएशंस आज कम हो गए हैं, एंड तो आपको जो कंपनीज मिल रहे हैं इफेक्टिवली एट अ डिस्काउंट मिल रहे हैं, एंड दैट इज व्हाई टुडे मिड कैप्स वर्क वेरी वेरी वेल. So I'll stop here, and Karthik, we could probably take a few questions and make this session a little more interactive.
Yeah, Shane. Yeah. So, in fact, I also have few questions which I thought it would be good for our investors also to know. We would love to hear your perspective as well. The first question what I want to ask is this the right time to be part of mid caps? Okay, because even though mid caps have all the potential to generate phenomenal returns, there is also a very interesting conclusion what we could look at from the histories. When markets are going down, it is always the mid and small caps which would probably fall steeper than large caps.
Correct.
So keeping that in mind, is this the right time to invest in mid caps? What's your thought on this?
So that's a very great question, and that is a very important question considering today. So markets markets are down YTD about 8-10%. Mid caps have fallen about 15%. So obviously, when you look at where mid caps fall, they are a more high risk strategy as compared to large cap strategy. So it is a very clear point. But if you look at the longer term growth potential, despite various events, so today the recent events are more news centric events, right? It does not talk about the health of companies. So today you do not see the Indian earnings space being badly affected because of, say, the Ukraine crisis or the Russia crisis, correct? So it is all a perception or a sentiment that has driven markets lower. So there have been many instances like this. So if you look at the last 10 or 12 years, every so often you will have situations wherein markets become more and more volatile. So we had demonetization, we had Brexit, we had COVID, we had the India currency crisis, we had the great financial crisis, we had the Indian rupee losing value very significantly in 2013. All of these situations came and all about, right? And in all those periods of time, you saw that markets were very, very volatile, but markets did recover. And for those companies that are good quality companies and companies that attract fair deal of long-term investor capital, you will notice that these companies tend to grow in a very, very consistent long-term manner. And hence we believe that mid caps today offer very, very good value because they have corrected and they have that long-term growth potential. So to summarize, basically, I went on and on for this, but in essence, today the opportunity for investors entering the mid caps is very, very good from a risk reward perspective.
So just to pick up from where you mentioned last, Shane, from a long-term perspective, mid caps definitely make sense. I think I'm in sync with you there. But any broad definition of long-term? How would you define for mid caps?
So we consider long-term as 5 years. So across all our products, we say that if you've got
a large cap or a mid cap, I mean 5 years
in a large cap, equity, the way equity works is the longer you hold, the better is your earning potential. So in mid caps, we take it one step further because they are more high risk assets. So if for example, large caps, you say 3 years is a good long term horizon, mid caps and small caps, we would typically say they are more 5 year type products, and that is what we use as a good enough yardstick. So do not look at 1 month, 2 month, 3 month returns. Don't look at even a 1 year return. Your objective has to be looking at long term, 3, 5, 7, 10, 15 years are good long term markers for you to identify whether your strategy has worked well.
Sure. So, with respect to mid caps, we've always heard since a very long time these stories like there are not many investable opportunities in mid cap. I think you brought out a brilliant point by mentioning or covering impact costs in a very simple way. I think that's been a challenge for mid cap fund managers for a very long time. There are
Yeah.
many instances where mid cap funds have stopped accepting fresh investments. Also, this has happened in the past. The moment fund size
Yes.
grew beyond a point. Now, the question here is, would that be a challenge? As the size of the fund keeps growing, uh, I
Yes.
know it's a passive fund.
Yes, yeah. So that's a so that is precisely why we did not decide to do a full universe product. So by virtue of taking the 50 most liquid companies, we are able to manage larger sizes. So like today, for example, if we talk about the Axis Midcap Fund, the
Yeah,
Axis Midcap Fund is probably one of the largest midcap funds in the country today. Uh,
yeah,
our ability to manage that fund has been driven by the fund manager's focus on looking at liquid
yeah,
mid caps, and
yeah,
we took that same aspect and we brought it to the mid cap passive strategy, precisely for the reason that people like mid caps in nature. People mutual fund investments and the Indian landscape, mid caps are very popular category. So we do not want to deny that opportunity for investors by launching a great strategy and then limiting that fund.
yeah.
So that is precisely why we said that let us target a portfolio that is liquid at all times. So that we give the investor the experience that he's looking at, and that is why we've kind of focused on these 50 companies rather than buying the entire universe.
So, can we say these are like larger mid caps when you say
uh, to a sense, because
2%?
when you look at mid caps, there are two attributes to it. One is
Mhm.
that there is a promoter holding, right?
Yeah,
So if you look at the company itself today, if you look at the mid cap universe, about 50% of the mid cap market cap is actually held by promoters. The remaining 50 is free float. In most cases, higher the free float, better is the liquidity. The second attribute to look at is the trading volume. Now, if your institutions, so within the free, obviously the promoters typically don't sell their holdings, so that is completely taken away. Even within the free float aspect, if that is held by large investors and they just hold it there, then it is
Mhm.
no that there's no great value in trying to create a strategy around it, because you will not be able to deploy
Yeah,
your assets. So what we're looking at is two aspects. One is that your free float is larger, and second is your trading frequency is very high. So trading, how is trading frequency high? You've got institutions that keep churning, you've got retail participation, you've got HNI participation, and all of that makes it a very vibrant ecosphere. And that is how we define the 50 most liquid, where the largest companies may not often be the most liquid companies.
liquid. Okay. So, liquidity is one very important parameter you're going to
Yes.
consider while creating.
Yes, it's a primary parameter that we're looking at.
Okay. So, see, the next question is from a passive versus active angle, right? The
Yeah.
moment we think of passive investing, I think large cap as a category makes a lot of sense because what we have also seen is in large cap category, not many funds would have even probably beaten the category average return also. It's
Correct,
only
correct.
few set of funds which actually outperform the underlying benchmark and the category average. But
Yes.
whereas in mid caps, that's not the case. Larger number of funds beat the underlying benchmark, and then the category returns also look very attractive. I think Axis Midcap Opportunities Fund itself is one testimony for that. Last 6 years, if we see the history till 2021 end, I think almost 4 years the fund has beaten the underlying benchmark and the category average handsomely well.
Yeah.
So when we have such kind of opportunities, a fund like this, where does it fit in from a portfolio construction point of view?
Sure, sure. So very valid point. Again, so when I started the conversation, I had mentioned that in mid caps, it is very important to select the right mid caps. Now, for fund houses, it becomes very imperative that they have a very strong investment philosophy. So we've got an investment philosophy which we think works very well. And you mentioned the performance of our fund. But there are certain investors who do not want to take that risk. So there is a huge degree of fund manager bias, or there is a huge stock bias that often creeps into active funds. And certain types of investors do not like those type of funds, or are averse to somebody managing the portfolio at their own gumption. They want to drive their car in a particular manner, like that. So for those type of people, a passive strategy makes a lot of sense, because a passive strategy is a very rules based thing. So for investors who are more rules based, or want to take their own path with their portfolio, passive strategy makes a lot of sense. Now, one valid point is that you have to have some degree of active management. So the way we have done active management within the passive fund itself is to make a subset, like we spoke earlier. I have not taken the entire 150 companies while creating the product. I have selected the 50 most liquid companies. So my rules are geared to identifying or taking market return while ensuring that there is high degree of liquidity. And if investors like what approach we are taking, for those people, we would recommend that you look at a passive offering as such. For those investors who do not have an inclination towards driving their own portfolio, or want a professional advice, for those people you can look to use an active strategy. Both strategies have their pros and cons. It is for the investor to decide what they want to do, rather.
Yeah, makes sense. I think on one side there is active, but what we can conclude probably here is it's not completely passive. There is some degree of, I mean, it will fit into the smart beta kind of a category. Can we say that?
So smart beta is more nuanced. So it would involve a lot of factor or logic based approaches. This is less of that. So while the tilt is towards a smart beta in your words, it is not. We don't categorize this as smart beta, because a smart beta is more quantamental or factor based investing, which is the next level of that. So we're not there yet. At least we don't think we are there yet in the Indian market space, because markets are still not very efficient, especially in mid and small caps. So using the traditional methods also, you can make a lot of money. So just to go back to our performance point, right? Today, if you were to look at, say, a mid cap performance, even in the worst of times, has been significantly above, say, large cap peers, which means to say that in general, if you were to benchmark your entire portfolio to the mid cap, or to the Nifty 50, by virtue of participating in the mid cap index itself, you've generated an alpha. So why would you want to then take more risk and then try and there are good chances, right? There's a 50-50 chance that you may succeed or fail. So a mid cap as a strategy can work both ways. So you can either use a passive strategy, or you can use a active based strategy.
So, Shane, to continue with the previous question,
Yes.
you can choose to, probably give just the like, let's say, highlights of this. To what extent would you see the overlap of the portfolio between Axis Midcap Opportunities Fund versus the current fund, what we are talking about?
So, so the Axis Midcap Fund is a midcap strategy, actively managed midcap strategy. Again, like I mentioned, the one of the parameters is liquidity. So what we've noticed, so we've done some degree of backtest, and you will notice that the portfolio typically has about a 40-45% overlap. So there, but the tilts are very, very clear. So if you were to look at the stock classification, you will see a large number of stocks there in certain degree of proportion. But where the fund manager adds the value is is skill in identifying which stock will do better than another. In the passive strategy, the Axis Nifty Midcap 50 Index, there is no fund manager bias. There is no. It's a completely rules based strategy. So it is what it is. So in essence,
I'm
it's
sorry.
about 40-45%.
Yeah, about 40-45% overlap is not much. Then an investor who has an Access Midcap active fund already could
Yes.
also consider giving a small amount of weightage to this fund.
Definitely. But again, so the general rule of thumb is that you don't have too many funds. So once you identify your investment strategy, it's
Yeah.
best you stick to it. So if for example, while I totally agree for investors who have a meaningfully large portfolio, you could look at some degree of active and passive. Be very clear on your investment focus, because what a passive fund offers you and what an active fund offers you are two very different return profiles, very different risk profiles. They work in different cycles. So investors have to be very clear, and that is where a financial advisor comes in to identify that, okay, we believe that an active strategy may work better for you, or a passive strategy may work better for you, or a blend of both could work for you. That is where your portfolio construction comes into picture.
Okay. So, from the current market point of view, we have already seen reasonable amount of correction.
Yeah.
Is it probably the time to go all guns blazing, go for lump sum investment, or would you say follow the STP route, still be cautious? We still don't know where the bottom is. What's your take on this, Shri?
So the problem is twofold, right? So let's look at the problem. What is the problem today? One problem is that there is a lot of sentimental negative. The sentimental negative is on two fronts. One is the Russia-Ukraine war. The other is rising global rates. The global rates, in our opinion, is a significantly larger problem, because as rates rise, for foreign investors in countries like India, which we bucket as EMs, the risk premium has to be significantly higher. So your expectation of return from the India market has to be significantly higher, and that is why you've seen the FPIs actually selling lock, stock, and barrel, right? So if you look at it, last 18 or 20 trading sessions, we have seen in excess of 3-4 thousand crore of daily FPI selling. Why is that happening? Because globally, FPIs believe that because the risk premium has now shifted, emerging markets itself have become increasingly more unattractive, right? So, and that is what has put pressure on the Indian equity markets. What has been heartening to note is that unlike the previous times, so the last time you had FPI selling of almost 30-35 thousand crore per month was the great financial crisis of 2008, and that time you had seen markets capitulate. So we had a drop of almost 50%. In this case, what you've noticed is that markets have fallen about 8-10%, and there has been a lot of buying from the domestic side. So the dynamics of the Indian markets have changed very dramatically. Gone are the days that if FPI sold, markets capitulated completely. Those are not happening anymore, right? So we are now entering a very dynamic market environment, and in such an environment, one approach is to say that I have a particular threshold. We believe that threshold is we believe that threshold is near current levels, and hence our portfolios have tilted more in favor of equities now. The other approach is for people who are still a little on the fence. You've been sitting on the fence for the better half of the 2020 and 21 recovery. This offers you a very good opportunity to re-enter at levels that were last seen in 2020. So you could look to start allocating more frequently, more regularly. Now, for some investors, it is a lump sum approach, but more gradual in nature. Some people who want to take a more nuanced approach can use SIPs or STPs.
Great. No, definitely makes sense. Um, uh, this one probably a fundamental question from a new investor point of view. Suppose someone is
Yeah,
entering the market
yeah.
now. What kind of equity funds should they have in their portfolio to diversify their risk, and how much of allocation you think they can have towards mid cap funds?
Sure. So obviously, there are a lot of investors who are listening to us. I will not be able to give one size fit all investment ideas, of course, but the general rule of thumb is to say that if you 100 minus your age should be your equity exposure, right?
Yeah.
Within that, depending on your risk profile. So typically large caps are the more safer or relatively safer equity investment. So your first fund should always be a large cap fund or a large cap stock, depending on how you try to build your portfolio. Your second fund should be a mid cap strategy. Why? Because that will be the one that actually creates the alpha over long term, right?
Yeah.
So depending on your risk profile, we would recommend that you would have anywhere between 30 to 50% of your assets in mid cap strategies.
Okay. Uh, so, in terms of midcap, coming back to midcap concepts again, there are multiple options available today. I mean, we have little close to 40 odd mutual fund companies and 25 odd midcap funds.
Yes.
What do you think some of the parameters one should keep in mind while selecting a midcap fund? How do we say, okay, these are the 2 or 3 funds I should have in my portfolio?
Sure, sure. So this is a very important aspect, because obviously, like you pointed out, the universe is large. One very important aspect is to look at performance not at the first metric but the last metric. Do not look at the performance of a mid cap fund, because if you look at the mid cap fund performance, if you look at any fund performance from today's standpoint, you are looking back in time. So performance as a barometer should be the last aspect that you should look at. And even when you look at performance, especially in mid cap funds, do not look at short term performance. 1 year is too short to identify whether your fund manager is doing a good job or not. At least 5 or 7 years is an ideal barometer to look at fund manager performance.
Yeah.
Within the mid cap space, what we are advising investors is to look at what is the underlying philosophy with which a person selects his stocks, the fund manager selects his stocks. If you identify with that, because see, if you go and buy a new mobile phone, you go and check what's under the hood, right? You go
Yeah.
buy a car, you will check the engine, you will check what are the features you get. Same thing you have to do for a financial product. And how do you do that? You go and read the literature. The scheme information document is very, very detailed. Today, SEBI makes all of us put a lot of stuff in the investment strategy. Just
Right.
go through each of those strategies. Pick 3 or 4 products that you like. Read through that investment strategy. You will know what the fund manager is thinking and how the fund manager manages his portfolio. The second aspect is the fund manager longevity. If the fund manager has conviction, he will hold his stocks for a long time. And you should never look at a portfolio that is a trading portfolio, because if it's a trading portfolio, that it is not a portfolio that will look to generate long term wealth. It will look to generate a cyclical wealth, right? And finally, you should look at risk adjusted returns. So higher the risk, higher the return potential, right? So if you are paying that kind of risk, paying for that risk, you should also be rewarded with that kind of performance. If you're not able to do that, that means the fund is not doing well. Lower performance does not necessarily mean a bad performing fund. Lower performance may also mean that the fund manager is being very cautious in times like this. For example, where you've seen markets fall 8-10%, by virtue of taking lower risk, your fund manager may have saved you 5-10% of downside risk. And isn't that a return in itself, right?
Yeah, of course. So, I mean, just to add to what you mentioned, when you mentioned risk adjusted return, I'm sure you're referring to ratios like Sharpe ratio and alpha.
Yes. So if investors are more financially inclined, they understand these things. For investors who don't understand this, what you do is you just take the NAV of the fund over the last 3 years and in an Excel format and just pull out the volatility. How do you pull out the volatility? It's the standard deviation of the fund. Higher the standard deviation, more the risk. Simple.
Okay. Yeah, I think that is one very interesting factor which I've noticed in many of your funds. The overall standard deviation is one of the lowest in the category
Yes.
and have a superior risk adjusted returns compared to many of the peers in the category. So I think what you speak, I think it reflects in your fund's performance as well.
Yes.
Uh,
So because we understand that a lot of investors, so there are a lot of investors who are not financial professionals, and the funds that we offer are not only for the financial professionals. We want a doctor, we want we want a high school teacher, we want a student. All of these also should get the benefit of it, and that's precisely what you are doing, Karthik, right? I mean, you are educating the masses at large with campaigns like this. So why not just simplify the product in its absolute essence, and offer products? And that is our aim. That has been our aim for the last 10 years or so.
So, what are your some of the within the funds, some of the conviction sectors where you think are where probably you're waiting the last couple of months and then say,
Yeah. So we've predominantly, so if you look at our portfolios, we are quite heavily invested in the financial sector, because we have this conviction that as the economy does well, banks and financial companies resonate that performance. So one of our key overweights is the financial sector. We also like the consumer space. So because if you were to look at the consumer space today, uh, they today in an environment where inflation is very varied, let's put it that way. Globally, you've got commodities rising. Companies are having difficulty in managing their raw material cost. It is companies like the consumer discretionary companies, or the consumer staples companies, that have the highest ability to kind of pass on those incremental costs to consumers, right? So today, if I was using Colgate ka toothpaste, I will not stop using Colgate toothpaste because it becomes 2 rupees higher, right? So my ability to pass on those costs are significantly higher than, say, for example, if I was buying a car. I would be a little more price conscious, depending on what category I was in buying a car, than compared to toothpaste. And hence we like the consumer sector as well. So banks, financials, and as well as consumers are some of our top overweights. We've selectively also added IT to our conviction list more recently, because of the rupee and what's happening with those companies there. So that's how our portfolios are positioned.
great. What's the expense ratio of the current fund is proposed to be? I'm not asking for an exact number, ballpark number, since it's a passive fund.
So typically we've priced our passive funds more aggressively, because by nature they are low cost products.
Okay.
What we are working with typically is about 20 30 point 2.3% as an expense ratio on the direct plan. Of course, the regular plan has is a function of what we pay. But in essence, what we're trying to do is we're trying to offer supremely low cost products, or good quality low cost products, and run these funds.
Sure. So thanks a lot, Shane. I think this is pretty much the questions what we got from the viewers and what we had in mind. We wish you very good luck with the new fund which you coming into the
Thank you
market
so
with.
much.
Thank you everyone for joining in. Have a great weekend ahead. Thank you.
Thank you. Thanks for having us.